Welcome. Stephanie, Evelyn, Queenbella, Elijah, and I, Francis, here to take you through our in-depth analysis of KCB. We recommend a hold with a target price of 27.20 Kenya shillings and upside of 11.02% from the current price of 24.5 shillings. Our decision is guided by KCB's enhanced move to fintech, growing market share, and flight to safety advantage and capital adequacy. With a rich history spanning over 116 years, KCB has moved from one branch in Mombasa in 1896 to over 260 branches, 11,948 agents, and 962 ATMs in 6 Eastern Africa countries. The first bank to have had a strong presence in the Africa Great Lake region with an asset base of 558 billion, market capitalization of 74 billion, and a total customer base of slightly above 10 billion. In terms of economy, Kenya's GDP growth rate stood at a stable rate of 6% with inflation at about 9%. However, KCB reported 3.4 billion loss in South Sudan due to the impact of the hyperinflation. In this, KCB reports a loan book CAGR of 11.73% and a customer deposit of 10.35%. In an industry still adjusting to the impact of the interest rate cap, strict supervision by the revitalized CBK that saw 3 banks going under receivership in the past 18 months, KCB has kept his head high among its competitors, emerging first in deposit comparatives and second in loan comparatives behind equity. In a bid to better this performance going forward, KCB plans to digitize its systems, consolidate its operations, better risk management, and improve customer experience.
Narrowing down to corporate governance, KCB has a well-structured board comprising of 11 members, 2 executive members and 9 non-executive members. KCB also has a number of shareholders, with foreign investors occupying the bulk of the shareholding at 28%. There are 6 committees made up of members of the board to help with the discharge of specified sets of duties that the board is tasked with. KCB continues to grow its relationships with stakeholders, particularly in the communities in which it operates, through the KCB Foundation. The bank's most recent flagship project to Jiajiri is a skills development and job creation program that seeks to catalyze employment and wealth creation among existing Jokali entrepreneurs and the youth. This initiative earned KCB the Best Sustainability Award 2016 from the Marketing Society of Kenya, and as seen, KCB has been awarded a number of accolades due to its stellar performance in different fields. With the recent amendments to the Banking Act, KCB has turned to digital banking to support and sustain its earnings, and it's doubling its capacity on its mobile phone systems to sustain up to 600 transactions per second by next year. KCB is also in the process of setting up a new financial technology unit, KCB FinTech, that is set to officially begin its operations by June 2017. KCB is also improving its customer approach to withstand increasing competition in the region by focusing on technology-driven solutions such as e-banking and multi-channel services to offer faster and more efficient and effective services to its customers. Onto the balance sheet, KCB has maintained steady asset growth over the years, and we expect that the loan book will decrease in 2017, thus the negative loan growth observed. The dividend payout ratios, as forecasted by the team, remain stable, as we expect the dividend payout ratio to remain at 2 shillings. However, KCB recently announced that they shall propose a final dividend of 3 shillings per share, thus driving up the dividend payout ratios. As seen, South Sudan remains fragile, with inflation rates above 400%. To mitigate this, KCB is minimizing operations in the region by rationalizing their branches and introducing a no-lending policy.
So back to Kenya. On the 24th of August 2016, the President appended into law the Banking Amendment Act, which introduced a cap of 14% on the lending rate and 7% on the deposit rate. Consequently, this led to a decrease in loans and advances and a NIM compression, but a subsequent increase in customer deposits. Now narrowing down to KCB's statements, we see that the loan would be at a 5-year CAGR of 11.73%, but we project this to decrease by 6% in 2017, attributable to the fact that the bank no longer has an incentive to lend. Conversely, deposit mobilization is expected to rise by 12% in 2017 due to the flight safety advantage that the lender has over Tier 2 and Tier 3 banks, given the recent dynamism of the financial sector. So from the above projection, we see that the loan-to-deposit ratio is expected to average at 76%, signaling that KCB will be able to sustain its loans. The group's NPL ratio stood at 6% in 2016, which is in line with the industry target. However, we project a 20% increase in NPLs from our deliberations with management. Now moving on to revenue, we project an earlier stated NIM compression of 4% in 2016. However, we project this to be supplemented by a proliferation of income from government securities, which stood at a 52% all-time high in 2017, leading to a net NIM stabilization of 3% going forward. So with the wake of the recent interest rate caps, also came a directive to banks that fees and commission income, the largest contributor to NFI, will be equally monitored. Now this, coupled with a subdued loan book, is anticipated to lead to a decrease of 26% in NFI. Finally, the decline in NFI and the NIM compression is expected to spill through to the lender's profit, leading to a 21.3% decrease in PBT. This will in return result to an ROE compression of 6.5% and an ROE compression of 1% in 2016. However, the significant decline in CIR from levels of 55% in 2015 to 32% in 2016 more than compensates for this dip in returns. This can be attributed to the fact that the bank used technology to acquire cheaper deposits. So from the above, we can see that KCB is in a trough. However, we project that this will be in the interim, thereby cementing our whole recommendation.
Moving on to valuation, we recommend a hold. This is based on 3 valuation models. The 3 valuation models are the asset-based valuation model, 2, the market approach, and 3, the dividend discount model. Starting with the asset-based valuation model, we got a price of 42.04 shillings. This was based on a discount rate of 20% and the treasury bill rate of 10%. We move on to second approach, that is the market approach, which gave us a price of 25.83 shillings. This was a product of our peer price to book ratio and our book value per share of KCB. Third, we have a dividend discount model. This gave us a price of 14.56 shillings. This was a result of a constant dividend per share of 2 shillings and a terminal value of 15.31. Eventually, we weighted all 3 models at an equal weight of 33.3%, eventually getting a weighted average price of 27.20 shillings. Therefore, since this is an 11.02% upside, we recommend a hold.
Finally, we summarized the risks faced by KCB on these risk matrix, the most prevalent being change in legislation, increased regulations, and compression in NIMs. The lender's profitability is forecasted to decrease by 21% in 2017 due to capped interest rates. Second is market rate risk, fiscal policy instability, and the forex risk. KCB has strategies to mitigate its risks. Working backwards strategy enables KCB to provision for Basel II, Basel III, and IFRS requirements, thus avoiding shock. KCB scored a 2.17 according to Camel's model. This shows that the bank performs above average, and therefore the same scale is also cemented by its 1.8 score in Porter's analysis, therefore showing that KCB is a bank that performs better in most of the areas, but however it has areas of improvements. Based on SWOT analysis, KCB's strengths outweighs its weaknesses, and therefore,
Ladies and gentlemen, based on our valuation, KCB fundamentals, risk and finance analysis, we recommend a hold. Thank you.
I've looked at your valuation. I just need just to give some color to your asset-based valuation model. Maybe you can explain what you did.
In our asset-based valuation model, we considered the biggest assets of KCB, which is their loans, then the biggest liabilities are their deposits. Therefore, we considered the equity value, which would be our assets as the big assets in total, in as much as the loans are more, assets in general, minus the liabilities to get the equity value. Eventually, we discounted all the equity values to give us a full enterprise value, which we then divided by the number of outstanding shares to get asset-based valuation.
So you got your equity, the balance sheet as at 31st?
Yes, because we did not have the final quarter of 2016. So we did a partial forecast of 2016 then moving on to 2020. So having gotten the equity value, we then discounted it, added it to get the enterprise value, then divided it by the number of outstanding shares.
Your dividend, how did you, what was that was the payout ratio that you assumed?
Okay.
Just constant, I mean, it's not going, no growth.
Yes, as explained by management during one of our meetings, they precisely say that the dividend per share would stick to 2 shillings. So after the announcement, just barely 2 weeks ago, that's when they issued the 3 shillings per share. But during our valuation, we considered that aspect, a constant dividend per share. So our growth rate in the dividend discount model was nil.
I mean, I'm just thinking, they said the dividends will not go, I mean, regardless of the growth in the company.
Yeah, they said they'd stick to a dividend payout ratio of not more than 50%, which would be roughly around 2 shillings dividend per share. So we just stuck to that as a constant growth.
So, okay, not look at your financials, but it seems to me like the earnings of this company are basically almost static or very minimal growth. Is that the assumption?
I could hand over that to my teammate.
So in the dividend discount model, the cash flow you're supposed to use is the dividends per share. So that's why we consider the dividend per share as being constant as informed by management. We didn't use an earnings cash flow, we used dividends.
So you just use dividend, constant dividend.
Yeah, given that it's the dividend discount model.
And this is based on management.
They were very adamant during our deliberations that they're going to stick to a DPS of 2 shillings going forward, but with the recent announcement, given their recent release of their financials, they pushed it up to 3. But since our valuation was before that, we stuck to a constant DPS of 2.
And just let me complete the valuation that you used. And so the multiples. So you used price to book. Where did you? How this is PR, which means what did you just take me through that? I just want to understand.
Okay.
How you did.
Our peer price to book ratio, we got it from our AIG index.
So okay, so whatever you got there on that day is what you applied.
Yeah, basically that is what we applied, and we chose price book to book value because, like we mentioned, loans is their biggest asset, so we thought it would be the best multiple to use, and then we went with AIG because it was a credible source of information.
And then you weighted all these with, you just weighted it. Is there no reason why you should not have considered one? I mean, because I'm just saying there's quite a big disparity. I mean, quite big, large margins between valuation.
Our decision to weigh them equally was formed by the knowledge that one, KCB is a market leader in the industry, and two, KCB's asset, KCB as a firm has the largest assets, and also in terms of dividends, they have been having a constant dividend share for the past 5 years. So considering all these factors, we saw the need to weigh equally.
Do you mind taking us back to the slide where you had your deposit comparatives? What do you mean by deposit comparatives and your loan comparatives?
It's just a comparative between the deposits and all tier 1 banks and all the loans in all tier 1 banks. We're comparing the levels.
In terms of market share or
the loan book, how many loans they have, how much the value in loans is.
okay, so you added all the loans by all the tier 1 banks and then see and calculate what percentage KCB has as relative to that. So it's almost like, oh sorry, go ahead. Is that correct?
For example, we can go to 2013 loan comparative, equity, which is the first bar.
Yeah.
It's about 200 billion.
Okay.
So the loan book is about
Okay.
200 billion.
So that's just
Maybe-
absolute values. You just
Exactly.
go, okay, fair enough.
Yeah.
And from this, we learned that KCB's has the largest size of loan book.
Not exactly.
Yeah.
Our decision to choose loan and deposit to compare the peers is led by the main function of a bank is basically to loan and to receive the deposits. So looking at this, if you look at the market right now, with the information that is there, KCB and Equity have been going head on in terms of which one is appealing to the consumers, where they find it easy to go and acquire loan, and where they find it easy to go and deposit. They find it safe to go and deposit their money. And so we looked at the deposits, absolute, and the loans just as they are.
Okay, fair enough. The next question is around ROE and ROA. You mind going to that slide? My question was, what was the calculated value of your ROE? Just looking at it, it seems your ROE and ROA are, your ROA seems to be above 20%. How did you calculate your ROA?
Earnings, the returns, which is earnings before tax, divided by the asset book of the bank.
And what value did you get for your ROA, just let's say for 2016?
So maybe I can explain this graph to answer your question. So we're trying to compare the returns against the CIR. So given this graph, the returns actually, the ROE actually averages at 4% from 2016 onward. But for us to compare this graph, the percentages had to change for everything to fit within the graph.
Okay.
Yeah, because CIR had very high levels, but something like ROE had very low levels, like 4%. But once you put that in Excel, this is what
Pulls up. Okay.
Yeah.
Fair enough. The next question is around valuations. So you're 17, if you go to the asset approach, you're 17 shillings per share. Sorry, you got a 42. No, you're 42 shillings per share. What does this represent? Is that the value of equity, or the value of total capital, or it's a value of, debt alone?
Okay, the asset-based valuation helps us to focus more on the internal aspects of KCB rather than the external effects. So it's more of a fundamental, it's more of the internal aspect of KCB, and therefore the intrinsic value. Therefore, 42.04 represents the price of KCB as it would be if only we considered its internal aspects in terms of its assets.
Okay, so this is the total number of assets divided by number of shares.
This is the enterprise value, which was achieved through getting the discounted equity value. You end up adding up, you get the enterprise value divided by the number of outstanding shares. So basically that is the price per share, considering, yeah.
Okay. So the listed price per share is the enterprise value divided by the number of shares.
Yeah, divided by the number of shares.
Fair enough. Below there you say you use a beta. What did you use as your level of beta?
Our beta was 1.2, which we got from Bloomberg, which is a credible source, which is actually KCB beta from Bloomberg.
Okay, and then last question from AIG index. So where this AIG index, is it from? And then why did you decide to go with that figure? Different banks have different PBs and different ROEs. And what was the logic for using 0.8?
It was the result of a combination of all the banks in Kenya. So basically it included all the fundamental aspects of every bank. So it was a fair ratio to use, the 0.8.
Okay.
Or didn't I get your question right?
Yeah, it's fine. Thank you.
I'll start by a basic question. Explain to me what you mean by a hold recommendation. I'm not very clear on that.
Okay, a hold recommendation means that what we are telling our investors is that they should keep the dividends or their shares that they have with us as for the next 5 years. So that is what we mean, that they hold their shares.
What if I'm not an investor?
Actually, what we mean by hold. A hold is better than a sell, but worse than a buy. So we are telling the investors who already have the shares in the bank that just hold them. As she had said, that whatever our projection is in the interim, and we expect that after this trough, after this trough, you are going to get a value for your money. As for the investor who is there with their money and they will want to invest in KCB, we are actually saying this, that with our projection, we will advise you not to rush into buying KCB shares. You could as well wait because of the fundamentals and because of our valuation.